Share the screen. Resets. Okay, we're here. Now, let me say it again before I just go quickly review on this, that first of all, the Zoom link will not be sent to you again. The Zoom link will not be sent to you again. You have to get it from the Moodle, or you just can type in the login as Alimshan Kimep. Just type Alimshan Kimep as a login. It will just get you to the class directly. Okay, this thing that I want to tell you again. And so here we are given a project that you had to solve it. It was based on the activity. The project has got some conditions like mutual exclusive and the cutoff period. So mutual exclusive means that you can select only one project out of several projects. You have to select only one, even though it gives you, though both projects are positive, NPV and so on. Cutoff period is 3 years. That is related directly to the payback rule. So it says that any project that exceeds in terms of the number of the years to cover the cost, you should not accept that project. So anything less than 3 years, you should go with that project. However, the projects are mutually exclusive. You can select only one project, which is the lower one. So according to the NPV, we select project B because it gives you highest NPV. And how we can calculate the NPV, we can calculate it using by financial calculator or the Excel function or manually. But in here, the Excel function gives you the NPV function is here. Here, you just put the rate in the first place. In the second place, you just select the range from C7, from C8 to C11 or B8 to B11 for the corresponding project. And close the bracket and subtract the investment cost. That would give you NPV. IRR is just function of the IRR and select all the range with this. And remember, the IRR is the rate that makes the NPV equal to 0. So it's the rate where the NPV is equal to 0. So I'm going to come to the issue of IRR. In the slides, we have some information dedicated directly to IRR. What is the pitfall or the drawback of the IRR? We're going to talk about that. Why the IRR is not reliable as much NPV. Payback rule, we talked about the disadvantages of the payback rule, that it does not consider the cash flow after the cutoff period. So cutoff period is 3 years. So whatever comes after the cutoff period, we don't care. We care just to cover the cost. This is the main thing of the payback rule. However, after the cutoff period, the cash flow would be the biggest one, and we might ignore it actually. And profitability index is another investment criteria measure. The higher the number, the better the position of the project. So it's an index, and it should be absolute term. More than 1, it's profitable. Less than 1, it's not profitable. But if it's mutually exclusive, you're going to select the highest one. As we can see, both of them are profitable because they both are more than 1. However, the project B gives you higher PI. Now coming to the final decision, we need to select the project. Which project is the best fitted? Which project is the best and can be selected according to a certain criteria? IRR, payback rule, and the PI has got some pitfalls. All your decisions. Yes?
Could you show the formula of the PI?
Because definitely. Yes. Now, let
B, for B, because we have another answer.
Okay. For the B. Yes, definitely you have another answer. Definitely. You are very true. You are very true. Thank you so much. I didn't pay attention. It just, the cell moved here. So my cell should be here. Like the interest rate, it shows that it's 0 actually. So it should be here. If you do it.
1.48.
Very good. Very good.
Yes.
I'm really happy that you're following me and you're really correcting me. I'm very happy. Thank you so much. Now, then my decision will be changed. It will be A here. So
yes.
Why A? Because the PI of the project A gives you higher profitability index. However, it does not affect my final decision. My final decision is based on NPV because the NPV is the best investment criteria. that NPV doesn't have any pitfalls like IRR, PR, and the PI. So NPV is the best investment criteria. All other investment criteria have some disadvantages, like multiple IRR problems. Like in one project, we may have more than one IRR. So IRR is not reliable as NPV. So what does the multiple IRR mean? I'm going to come to this point when I shift directly to the slides. I'm going to illustrate scales and patterns of the cash flows ignored, and the scales concerned. If the scales are very huge, like here, you can see the PI gives you a misleading result. And cutoff period is ignored. The cash flows of the cutoff period in the payback rule is ignored, so it's the biggest problem as well. So there's no time value in the payback rule. And so there's issues related to this investment criteria. We select according to the NPV, okay? This should be your explanation while selecting the according to NPV. This Excel file will be uploaded to the Moodle, okay? I'm gonna save it. Let me just save it again, because there is some issue related to that. 1220.
Professor, sorry, what about the discounted payback period?
I did ask you to do discount payback period, but yes, very true. It's same thing. If you do it, you need to just discount it here, all of the variables, and you calculate the payback rule. Okay, let me do it quickly here. So we are discounting the variables. So 175 divided by 1 plus 15%, and we're raising to the power of 1. And we go so far. Same thing we do. Okay. Just scroll down. So in this way, you have to use minus 290 minus 500. So the payback rule. So we proceed the same way. So 137 left. So from here, so we're not going to select the whole period. We're not going to select the whole period. We're going to select part of it. So we stop here and we say that it is equal to one year fully selected, because we use the cash flow of the 1 year fully, plus the amount that you are using here, which is 137.826 divided by this amount. We can see it's more or less the same, but still it's higher, okay? Oops, it's years. Same thing we do here. Let me just make it black. This is discounted payback rule. And if you want to select here, like 500 plus this, and we go further, and we can see that 2 years fully used, and we need just part of it from the third year. We're not going to use it fully. So 2 years plus 143.478 divided by this amount. This is the required rate. So what we can see here, guys, that your conclusion should be about the discount payback rule. So when you use when you take into consideration time value, that the payback rule changes its the length of the coverage time. So if you take the time value, it requires the longer period to cover the cost. So even though We try to solve the issue related to the time value, but still it has a pitfall. And the biggest pitfall in here is that it does not consider any cash flow after the cutoff period. Our cutoff period is 3 years, okay? So whatever comes after, we don't take into consideration. You can see 70 million here and 295 million here. So we do ignore it, but we cannot ignore it. It's our profit. This is what we were working for, actually. This is the payback, discounted payback rule.
Sorry, could you again show me discount payback rule for 1.62
Yes.
formula? Okay, thank you.
Okay, you're welcome. And here we have it here. Let me ask a question. Do you have any problem, any one of you, while solving it? Please, if you have, let me know. Write it to me. I will dedicate a separate time to you and we go again through it, because now we are moving into more comprehensive example, which is gonna really very important. And this thing that you should know as you know all your fingers. Okay? Like calculation, NPV, like with one click, you should calculate everything, because what we're gonna start now, it's like projection of the cash flows. It's very important and things that you really should know it. If you don't know, if there's something that you missed, you can ask now, or it's better to ask me to dedicate a separate time for you, like maybe after the class or tomorrow in the daytime, like half an hour, we can work on that. We can manage it to fix that gap that you have it, actually. Feel free to write me, WhatsApp, email, you're always welcome. Okay, I'm saving it. I'm sorry, again, forgot. Now, closing this. Okay, now let's
Is it
move on.
possible to use financial calculator during the exam, or we'll do everything on Excel?
You know, it's better to use the Excel. When we get into the project cash flow, projection of the cash flows, you will understand why we need to use the Excel. It will make your job much more easier. If you have any problems in Excel, please let me know. We can work out again. You have any problems with Excel, don't feel shy. Please do not hesitate. Write me directly. You can write me privately. You're always welcome. Okay. Because the numbers that we're going to deal with are really huge, and that's why we'll need to have Excel. So the one thing that I want to solve, the question in here is related to average accounting return, that we have not solved it. I said I'm going to solve it. So it is the average net income over the average book value. So it's basically you're putting the target rate, let's say 30%, and whatever you get in this formula, if it's higher than the target rate, then you just proceed with this project. An example is given here. We're given net income for calculating average accounting return, okay? Cash expenses, depreciation, earnings, ABT, and taxes, and the net income are here, okay? In year 1, 6,000, in year 2 is so on, 24, 48, 18, and 6,000. So according to the formulation, here's the formula, average net income, you should take the average of the all net income, divide by the average book value. So negative tax occur in 5 years, ABT is minus 10,000, okay, and deducted against the earnings and project reducing to 4,000. So if average book value is given, as 100,000, okay, and how it's given, because you purchased an equipment and the cost of that equipment is cost of equipment is 200,000. And its depreciation straight line to the zero, okay, to zero. depreciation straight line to 0, okay? Now, the average book value is equal to 200,000 plus 0, of course it's in brackets, divided by 2, which is 100,000. And average net income is equal to, you're going to add them all the net incomes, like 6,000 plus 24,000 plus 48,000 plus 18,000 and minus 6,000. And all should be divided by the number of the observation that you have used in net income here. 1, 2, 3, 4, 5. You divide by 5. And your average net income is equal to 18,000. So average accounting return is equal to 18,000 divided by 100,000. And the rate is equal to 0.18 or 18%. If your target rate, if you have put target rate as, let's say, 25%, then you should not accept this project because your average accounting return is less than this 25%. This is the calculation of average accounting return. Okay.
Sorry, where did you take $200,000?
I'm just, it's from the book example, okay? It's given always.
Oh.
This is the cost of the equipment you paid to purchase a certain equipment, okay?
Okay.
It is the cost of the equipment. And if you even just sum it up, this depreciation, because it's straight line depreciation, like the cost is divided by number of the years, and you get the depreciation amount. They're like 5 years, 40,000. In summation, they make 200,000.
Mm-hmm.
Okay, it's straight line depreciation.
Okay.
Okay, this is what I wanted to share with you. Now let's proceed. Okay, this is, okay guys, there is a depreciation methodologies. One is straight line, the other one is MACRS, or which is a modified accelerated cost recovery system. So this table is given to you, okay? So if you are planning to use this method, or if the condition is asked, so some questions we're gonna use with the straight line depreciation method. In some questions, we're going to use with modified accelerated cost recovery system methodology. We're going to use it, okay? So I'm going to show you how it works, how you just use this one. Okay. We just passed it. Okay, here. I said that IRR has some issue. They have some issue. Look at here. This is the point of IRR, okay? Like 13%. At this point, NPV is equal to 0. At this point, NPV is equal to 0. So it just crosses directly 0. So on the left-hand side, the y-axis is the NPV, and x-axis is required rate of return. So at this point is equal to 0. The NPV is equal to 0. So it is IRR rate. So it's like 12 something point something. So NPV and IRR methods may rank project differently, as we saw in our example. If the projects are independent, accept if the NPV is more than 0. that produce the same result as when the IRR is more than R. This is what we believe, but in real cases, when you calculate, it doesn't come true. So you have to work out on that. Whenever the NPV and IRR rank to mutually exclusive project different, they choose project based on the NPV, the net present value, reinvest the cash flow at the required rate of return, opportunity cost, and the IRR, reinvest the cash flow at the IRR rate. So the problem is the evident when there are different patterns of the cash flows, which means in one project we have two different negative numbers, like the first investment cost and the second cash flow that you're receiving can be a loss, not a profit. There's no guarantee that all the years that you are in a project, you will get all positive cash flow. Sometimes you may get a negative cash flow. In that case, you may have more than one IRR. So which IRR to select, you don't know. So same thing in here. This is an example of NPV. So here we have only one IRR, but if this was negative, okay, that means NPV line will pass that x-axis line of the required rate of return twice. So, but which IRR we don't know. So here we have more than one IRR. I'm going to show you how to calculate even two IRRs here later. But the problem is said when it said the like different patterns of the cash flow, this is what it meant. Like negative cash flow here, negative cash flow here. So this is a very big problem related to IRR. So we cannot accept the IRR as reliable investment criteria as NPV. Okay. Multiple IRR, like in one project. Okay, here's an example. So in here, in this place, NPV is equal 0 and NPV is equal 0. So IRR in here is 2.85, IRR is here 34.24. So which IRR is you have to use? You don't know. You cannot say the first one I'll take or the second one is higher. If you compare two different projects, yes, you're right, you can take highest IRR with a comparison to another project. But if you're talking about the same project, you cannot say that I'm going to select the highest IRR in the same project. You don't know which one is the true one. Because in both, they give you the NPV equal to 0. So this is why it's the biggest problem of the IRR, and that's why it cannot be relied as much as other projects. Okay, okay, now we came to the cash flow projections. Before going to cash flow projection, let me just show you how do I calculate multiple IRR, but you're not responsible, but if you will wish, you can use it for your own concern. IRR, you open the brackets, okay? We select the range. In here, you can see the guess, okay? Guess rate. So we need to put that one as well. Guess rate, which is, let's say, 0.05, okay? It's just guess number. You can put any number. Then I put IRR again. But I will change this to 10%. Then I will repeat it 4 times, okay? Change this to 15% and change this to 20%, but shift the range here. Make it 5%, 10%. 20%. Put it 25% here. Add one more minus sign here. Okay, anyway, it doesn't work here. I don't know why I have to fix it out. But as I told you, you're not responsible for calculation multiple IRRs. It's meaningless to calculate it because you're not going to use it. But anyway, you have to at least to calculate the first IRR where the NPV is equal to 0. Where the NPV is equal to 0. Okay, time came to go with the cash flow projection. The goal, we know how to calculate NPV and so on. This cash flow that we were dealing it, okay? We were getting these cash flows, okay? But how can we estimate these cash flows? Have you ever asked yourself, who estimates this cash flow? How do you come up with these certain numbers? 175, 290, 85, 70, 110, and so on. How do you go with that so you get these numbers and then? So now our job is to calculate. We know how to calculate NPV. We know how to calculate IRR, PR, and the PI. But now the job is to go with estimation of the cash flows. Okay. So in here, we're given investment outlay, which is investment cost, after tax operating cash flow, after tax operating cash flow, 5 years, and the last one is the terminal non-operating cash flow. When your project ends, you sell your equipment, whatever you realize from that, you pay on tax on that and add this terminal non-operating cash flow back to the after-tax operating cash flow. So this money added back, and then you get the total after-tax cash flow and so on. So this is the way of calculation. I'm going to show you in Excel. So that's why you will see why we need to use the Excel. There are many of the calculation numbers. So to calculate the investment outlay is the capital expenditure, the money that you spend to start the business, and increasing net working capital. And net working capital is difference between the current asset and the current liabilities. So the daily activities that you're being involved in the business. So any changes in that, it will be added to investment cost. So when it says subtract, so minus minus, it give you the summation, okay? That's why it just give you subtraction in here, okay? Just be aware of that. So your initial outlay is equal to summation of the change in net working capital and spent money on the outlay. Investment in fixed capital and investment in net working capital. And how we derive, okay, we know how to calculate the outlay. Investment cost is investment money you spent plus change in net working capital. And net working capital is current asset and current liability. But how do we calculate this after-tax operating cash flows for 5 years? Here we go. Sales, it's an income statement. It's an income statement, or it's a profit loss and account. So sales minus cash operating cost of goods sold or cash operating expenses plus depreciation. Depreciation here, we're gonna be going through straight line depreciation and modified accelerated cost recovery system depreciation. So it depends. You should be very careful while reading the question. So which depreciation methodology you should use to calculate it. Operating income before tax, EBIT, how you calculate. Sales minus this, you get the EBIT. And for simplicity, we assume there is no interest. We assume there is no interest. Directly tax. We got EBT, earnings before tax, and minus tax on operating income. That will give you operation income after the tax, plus depreciation. Depreciation is the non-cash item which should be added back. So we add the depreciation back after deduction of the tax. So we receive after tax operating cash flow. So this is how we calculate it. So we know how to calculate investment outlay. Now we know how to calculate this 5 years or 6 years or 10 years or 1 or 3 years of after-tax operating cash flow. It is using just income statement methods. Have you taken any accounting courses?
Yes.
No.
Yeah. Yes.
Okay, if somebody has not taken, we're going to introduce it yet. You're going to see the income statement. What is the balance sheet and the income statement itself? So we know how to calculate investment outlay. We know how to calculate after-tax operating cash flow. Now the time came to calculate a terminal non-operating cash flow. Okay. So the last part of calculation of cash flow projections. And then we're going to add them up and try to calculate the NPV. Now, just want to illustrate. Okay. As I told you at the beginning that you are welcome to use the financial calculator. But the financial calculator you will be using to calculate only NPV and IRR, these variables, okay? The last part and the easiest part. But for calculation, you need to use the NPV. I don't know, if you feel free to go by hand manually, you are welcome. It will maybe double consume of your time. Maybe if you could have spent it 10 minutes of calculation of projection cash flow, by manually, it would take maybe up to 30 or 40 minutes. You're welcome. But using the Excel, if you just solve this part automatically will be solved. Now, I'm going to put it here. Oops. Let me make it like this. Where was it? I want to take to the Excel side, just wanted to compare, to see, to show you. Now, investment outlay is this one. We know how to calculate. Change in net working capital and fixed capital, okay? Fixed capital is your investment cost, that you start your business, you spend the money. After tax operating cash flow is here. This part, okay? This, they're all same. For simplicity, same. But we will deal with the cash flow projection when these numbers are different, okay? You will see how we manage it to make it different. But now, what you're responsible for, they are fixed, okay? How to calculate the after-tax cash flow is just a simple income statement. All revenues minus all expenses, you get earnings before EBT, earnings before tax here. So from here, you subtract these red lines. You get EBT. From here, you subtract the tax, and then you get operating income tax. Then, as depreciation is non-cash item, you have to add it back to get after-tax operating cash flow. So you're adding back after-tax operating cash flow. So this is how we calculate after-tax operating cash flow. Now, turn came to explain the terminal non-operating cash flow. So once you calculate this one, the other one will be calculated automatically if you use correctly the Excel function here. So everything, this all depends in here directly. Then you just drag everything here, cash flow projection. This is your cash flow projections. And you calculate your NPV based on these cash flow projections. Calculate IRR based on here. and payback rule, PI, and so on. But the part, this terminal non-operating cash flow is important as well. Before I proceed to this one, please tell me, do you have any questions?
Could you again explain about after-tax operating cash flow?
Sure, sure. Let me go slowly, very slowly. You will get, first of all, I will explain it now again, but later when we get into practice, do it by yourself, you will understand much, much better, easiest. This is the easiest part. So we have sales, you sell something. You have a cost to produce something that you sell it. Depreciation here. So from sales, you subtract this two. You get earnings. So D9, this one, minus D10, D11, 90, 35. And you get 95,000. Then from this, you should subtract the tax. Tax, we get it how? 40% of earnings after deduction all the cost. Then after that, when you deduct your tax, there is an operating income after tax, like income after payment of the tax. To this income, you should add the depreciation back, because the depreciation is the non-cash item. It should be added back always when we do the projection of cash flows. And after tax operating cash flows is income after tax plus depreciation. So they're all same, you see? We assume sales, but how the sales we get it, how we get the sales, it can be, let's say you produce 110 units with a $200 each unit, okay? How you can find it? If you produce 110 mobiles and you're selling each mobile by $200, how much money you're gonna earn from this? How much money you're gonna sell for, total?
Multiply.
This times,
What is this?
yes? If it's,
Yes.
let's say, you're producing 1,100. So you're producing 1,100 units, mobiles. This is US dollar per unit. This is how we find the sales. But if, let's say, the cost is $90, or let me just make it number so we can. $81. The cost is $81. Okay, the cost is $81 to produce each mobile. How much it would cost you to produce all these 1,100 unit mobiles? So what do you do? This time this, 90,000. Yes. This is how it works. This is how you find it. So sometimes it will be given to you. Sometimes you have to calculate by using these numbers. And just a simple account. Okay, now we know how to calculate the investment outlay. Now we know how to calculate after-tax operating cash flow. Now the turn came to calculate terminal non-operating cash flow. So terminal year after tax is non-operating cash flow, abbreviated as TNOCF. It starts with after-tax salvage value. Okay, you sell it for something, let's say for 50,000. You sell it for 50,000, and you're taxing it. Because you sold it, you gain something on that. You have to pay tax. So you pay the tax on it, you deduct it. And you're adding back the net change in net working capital that it was previously included in investment cost. Okay. So anything you sell it, for example, you sell your cost for $50,000, you sell it for 50,000, and if the tax is 40%, so 50, this is not related to this example, okay? I'm just making up numbers. 50 times 0.40, so 50 minus this. This is after tax salvage value, plus if their change in net working capital was 20,000, okay, or 35,000, you're gonna add this 35,000 to the after salvage value, after tax salvage value. So in total, they're gonna be 65,000. So your terminal non-operating cash flow will be equal to 65. So after tax salvage value, return of the net working capital, change in net working capital, add it, and which is equal to non-operating cash flow. Any question? Anything you want to ask? So, so far, I have introduced you how to calculate investment outlay, how to calculate after-tax operating cash flow, how to calculate after-tax operating cash flow for all years, and plus how to calculate terminal non-operating cash flow. So what do you do the next? You need to come up with a total after-tax cash flow. So how you do it? Here, your total, you're bringing here down. Then, after-tax operating cash flow, you're just bringing down until the year when you terminate your project. Because in that, you have a terminal non-operating cash flow. So terminal non-operating cash flow, 70,000 in here, and the cash flow after tax payment is 92,000. So you should add them up together. 92,000 plus 70,000. So total after-tax cash flow in the last year is equal to after-tax operating cash flow plus terminal non-operating cash flow. This would give you this. So you get this cash flows to calculate the NPV. And the last part, what is left, is just to calculate NPV. It's the easiest part. You just put the NPV function. Discount rate is 8%. You get this range from G to H, from G23 to H23, from 92,000 to 162. Close the bracket, and you subtract the investment cost. Your NPV is positive. IRR, same, you get all the range. We can see that your IRR is higher than 8%. Then NPV with IRR is equal to 0. We can calculate PI here. So NPV 8%. We get this value and divide by the investment cost. Our PI is equal to 1.80. We can do the payback rule. We can do the discount payback rule as well. So Any questions?
No.
Okay, we are left with 10 minutes. We are left with 10 minutes. I was planning to make it the comprehensive example to start together to solve one question, but I think in 10 minutes, it's better not to start. So whatever we have learned, please go home and revise it before we start the next class. Because next class, we're gonna start with the example. I don't want you to have any problems. In the previous semesters, the students, they felt that they know everything, but in the exam, they failed. I don't want you to do it again. Please, the questions are very easy, but there are many things to solve. There are many things we need to put everything in proper order. So before doing this, you have to know this fundamental information before we start calculation any numbers. So I will stop here. I will let you go by 10 minutes earlier. You have to revise it at home before we meet next time. If you have any questions, feel free to ask. If you don't have any questions, thank you so much. See you next week. Have a nice classes for your other classes as well.
Thank
Okay,
you.
bye.
See you.
Thank you. Goodbye.
Goodbye. Thank
Take
you.
care.
Thank you. Bye.
Thank you.
Thank you.
Bye.
Thank you. Bye.
I have a question.
Yes, please.
Can you return to the previous assignment?
Yes, surely I'm gonna come to that
You're
one.
right.
Just a second.